Welcome to this video supplement for the pre-license training life-only exam. Remember, this is not a word-for-word rendering or reading of the material, but a summary of the high points and important concepts and some brief explanations. If you want a word-for-word reading of the material, you can select that option on our website, and our computer genie will read the text to you word for word. Here we're going to summarize the important points and give some basic explanations. So let's get started with the first section on general insurance. The first step in studying for the pre-license exam is to understand the purpose and important role served by life, annuities, disability, and health insurance for individuals and society. The next step will be explaining the concept of risk and how insurance is designed to replace the uncertainties of risk with guarantees. Included in this section will be definitions, concepts, and principles that apply to all classes and lines of insurance. Life insurance, which is based on actuarial or mathematical principles, guarantees a specified sum of money upon the death of the person who is an insured. Health insurance, also based on actuarial principles, was developed to provide funds for medical expenses due to sickness, illness, or injury, and to cover the lost income during a disability. Annuities provide a stream of income by making a series of payments to the annuitant for a specified period of time or lifetime. This section focuses on how all this is possible. Have you ever wondered how an insurance company can charge a 35-year-old person $20 per month for a $250,000 10-year life insurance policy? It sounds impossible. This involves risk transfer and the law of large numbers, which are two principles upon which insurance is based. Risk transference, sometimes called pooling or sharing or spreading, involves the transfer of risk from the individual to a group pool of the insured's policyholders. Using this example, by purchasing insurance and paying $20 a month premium, a person shares the chance of loss or death with a group of others. Normally, only a small percentage of policyholders suffer a loss. The losses are paid out of the premiums collected from the group of policyholders. Thus, the entire pool compensates the unfortunate few, all of whom share the losses and have the promise of future benefits in the event of their own death. This reduces the individual's potential for disastrous financial consequences to just a small premium. The real significance of insurance is its promise to substitute future financial or economic certainty for uncertainty and to replace the unknown with a sense of security. This promise is made through an insurance policy, which is a device or an instrument that provides the funds to meet these uncertainties. In the absence of insurance, major disasters such as 9/11 would have crippled our entire economy for many years. Insurance provided life, health, workers' compensation, and property damage benefits to the 9/11 victims, which helped individuals and society recover from this unexpected disastrous loss. Let's look at the definition of insurance. According to the California Insurance Code, referred to throughout this text as CIC, let's look at the definition of insurance. According to the California Insurance Code, insurance is a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or unknown event. A contingent event is one that may or may not occur in a given time period. Another example is whether a person will die or become ill or injured this year. Insurance is written to cover a person's exposure to unforeseen, unintended, and unknown events that may or may not occur over a given period of time. It should be noted that this course focuses on life, disability, and health insurance, as well as annuities. An occasional reference may be made to other types of insurance. Here are some definitions of insurance. Insurance is a substitution or exchange of a small certain loss, the premium paid, for a large uncertain loss, the claim. Or insurance is a social device that transfers risk from an individual to a group, the insurer, thus pooling a large number of individual pure risks. Funds to cover the individual losses are raised by collecting premiums, in exchange for assuming the losses up to a predetermined limit. Or insurance may be referred to as a written instrument, contract, or a policy. All these definitions may show up on the test, and remember these key phrases. Insurance is a contract to indemnify another from a contingent or unknown event. Insurance is an exchange of small certain losses for a possible large uncertain loss, exchange of premium for a claim. And insurance is a social device transferring risk from an individual to a group of individuals. Let's now look at the definition of risk. Risk is the uncertainty about loss that arises or exists when there is a possibility of more than one outcome, some of which can be negative. Examples include uncertainty about whether or not you will have a car crash, or die prematurely, or have to be hospitalized. Risk means there's a question of will it happen, or when, and what are the consequences if it does. Insurance is purchased for the risk that losses might occur. Remember, risk equals the chance, possibility, or uncertainty about a loss occurring. There are two main types of risk, pure risk and speculative risk. Pure risk involves the possible outcome of loss or no loss. There is no possibility of gain or profit from pure risk. Pure risk is the only type of risk that insurance companies are willing to accept. Speculative risk involves the possible opportunity for either loss or gain. Examples are playing the lotto or gambling or investing in real estate. Speculative risks are not insurable. Let's look at the definition of peril. A peril is the actual cause of loss. Some examples of common perils are fire, wind, hail, collision with another car, or theft. A peril is the immediate specific event causing the loss and giving rise to risk. When a person dies, the cause of death, such as cancer, heart attack, or stroke, is the peril. When injured due to an auto accident, the auto accident is the peril. So remember, peril is the cause of loss. Now let's look at hazard. A hazard is anything that increases the chance or the likelihood that losses will occur, or the severity of a loss that does occur. However, it does not actually cause the damage. In property insurance, placing flammable material too close to a heating source would be a hazard that increases the likelihood of a loss. There are four types of hazards. The hazards that are concerned to an insurance company are moral hazard, morale with an E hazard, physical hazard, and legal hazard. Moral and morale hazards deal with the insured's personal character and behavior problems that can increase the frequency and or severity of losses. The fundamental difference between these two types of hazards is intent. A moral hazard results from deliberate acts. A morale hazard, ones with the E, results from carelessness or indifference. So let's look at this in detail. Moral hazards are associated with mental attitudes, behaviors, ethics, and habits. Examples of moral hazards are dishonest acts such as lying on an application, exaggerating a loss to get more money, bankruptcies, judgments, fraudulent claims, or breaking the law. In life and health insurance, alcoholism and drug addictions are considered to be moral hazards. A morale hazard, on the other hand, morale with an E, are similar to moral hazards because they deal with the way people think, but morale hazards deal with a person's state of mind. People will think, oh, it's insured, so why do I care about it? I don't lock my car, it's insured. That presents a morale hazard. Morale hazards arise out of human carelessness and irresponsibility. These can increase the chance of that loss occurring or the severity, meaning how much the insurance company would have to pay if that loss does happen. A physical hazard in property casualty insurance, a physical hazard is anything that poses a risk and can be seen, heard, touched, tasted, or smelled. Examples are a weak tree limb that might fall on a house, or worn out brakes that might cause a car accident, and the absence of a fence around a swimming pool, things you can see. In life, health, and disability policies, physical hazards would include the insured's height or weight, maybe they're overweight, their occupation, maybe a dangerous job, or past or present health issues, or blindness, or dangerous hobbies like skydiving and deep sea scuba diving, or the type of vehicle the insured drives, a hot sports car, just to name a few. Then legal hazards is the chance of a certain risk ending up in court, which creates the legal hazard. Any action from a court that increases the likelihood of a loss or the size of a loss is the legal hazard. So just remember, moral is dishonest, morale is carelessness, physical are hazards you can see, and legal hazards are based on court decisions. Let's now talk about the law of large numbers. Basically, the law of large numbers states that the larger the amount of information gathered to develop statistics, the more reliable the information will be. Statistics based on a survey of 5 million people are more reliable than statistics based on a survey of only 5,000 people. For the law of large numbers to operate, it's important that a large number of exposure units of similar risks, also known as homogeneous risks, be combined. The exposure unit in life and health insurance is the economic value of the individual person's life. The law of large numbers does not suggest that losses to a particular individual will become more predictable. Rather, it states that the larger number of exposure units or individuals within that group, the more predictable the losses will be. This means that as the group gets larger, projected losses will be closer to reflecting actual losses, allowing the insurance company to predict with reasonable accuracy the number of claims it will face during any given period of time. See, insurance has to charge in advance and predict in the future how many claims it will have to pay. By using the law of large numbers, they can be more accurate in predicting and therefore charge a more accurate premium. The law of large numbers is the basis for the mortality and morbidity tables used by insurers to establish rates. The mortality and morbidity tables were established by actuaries or mathematicians by compiling statistical data regarding exposure units and risks. Mortality tables show the incidence of death by age and sex among given groups of people. Similar tables, called morbidity tables, show the incidence of illness or accidents among groups of people that are categorized by age and sex. Insurance companies' premiums are calculated to cover the expected losses and cover insurance companies' expenses and a profit. The expected losses are based upon the past experience of the average risk. This means that the law of large numbers is used not only to predict future losses, but also to determine how much premium to charge. The larger the group, the more accurate the premium charges. This benefits the insured because it means there will be fewer rate increases and the money will be there to pay the claims. Let's now talk about loss exposure. So what is loss? Insurance interprets loss to mean any reduction in the quality, quantity, or value of something. Loss can mean bodily injury, it can mean property damage, death, loss of income, incurred extra expenses, medical expenses, pain and suffering, or an obligation to pay for any of these types of losses, depending on the type of insurance policy. Loss exposure refers to the possibility of a loss. It's any condition or situation that presents the possibility of a loss, whether or not an actual loss occurs. There are conditions and situations that expose a person and a person's assets to losses. This measures the vulnerability to loss is usually expressed in dollars or units. Let's talk about how to handle loss exposures. There are 6 steps to the risk management process. Risk management is how we handle loss. The first step is to identify the loss exposure, then analyze it. Examine the alternative risk management techniques, how you would handle that. Select the best technique, implement that technique, and then measure and monitor it and revise as necessary. At this time, we'll review how risk is managed. Treatment of risk will depend upon the degree of loss to your client and their own individual situation. The following are the 4 main methods used to manage or treat risk. The 4 options are transferring, avoiding, retaining, or reducing. Remember the acronym TAR, T-A-R-R, transfer, avoid, reduce, or retain. Let's talk about risk transfer. When a risk is shifted to another party, it is referred to as a transfer. The most common form of risk transfer is for an individual or group to purchase insurance and transfer that risk to the insurance company by purchasing insurance. However, purchasing insurance does not eliminate the possibility of illness, injury, or death. All it does is shift the financial burden to the insurance company. A test example is purchasing, increasing, adding to an insurance policy are all examples of risk transfer. Let's talk about risk avoidance. Risk avoidance is one method of managing risk. If a person wanted to avoid the risk of being killed in an airplane crash, he might avoid air travel altogether. If you want to risk dying in an auto accident, don't get in a car. Test examples of risk avoidance are not proposing to your girlfriend or not participating in something such as skydiving. So you completely avoid the activity altogether to then reduce that risk. Risk retention is one method, and one method is to not purchase insurance at all, but pay for all the losses out of your own pocket. Another form of risk retention is to self-insure. This can be accomplished by setting aside money in a bank account to offset the cost of a potential loss if it occurs in the future. Or an example would be taking a large deductible and setting the amount of that deductible aside in a savings account to cover the cost of that deductible in the future if a loss occurs. Test examples of risk retention are self-insuring, retaining a portion of the risk through deductibles, and please note that risk retention is not a benefit of insurance. Let's talk now risk reduction. Risk reduction is taking steps to lessen the chance or lessen the severity of a loss occurring. Though we cannot avoid dying, we can reduce the chances of premature death by controlling what we eat, exercising, quitting smoking, getting annual physicals, just to name a few. So test examples of risk reduction are not taking a hot air balloon ride over 100 feet or always wearing seatbelts when driving a car. There are three major types of risk situations people are exposed to: property loss exposures, liability loss exposures, and human, personal, or personnel loss exposures. A property loss exposure is the degree of loss a person or organization faces in regard to property, buildings, or personal property. Property includes real property and personal property. Real property is land, buildings, and any other property attached to it. Personal property is everything else that is not real property, like your contents or the stuff inside the building. A liability loss exposure is the degree of loss a person or organization faces in regard to lawsuits brought by a third party. It is any condition or situation that presents the possibility of a claim alleging legal responsibility of a person or business for injury or damage suffered by another party. If your product, for example, hurts the customer, you can be sued for liability. That's an example of a liability loss exposure. And then personal, human, or personnel loss exposures. A personal loss exposure presents the possibility of a financial loss to an individual or a family because of death, disability, unemployment, illness, or injury of the primary wage earner. A personnel loss affects a business. A personnel loss exposure presents the possibility of financial loss to a business because of death, disability, retirement, or resignation of a key employee of that business. Let's now talk about the ideally insurable risk. Not everything can be insured. The term ideally insurable risk means that the risk is financially within reason, meets all or most of the following criteria, and therefore is considered to be reasonable to insure. Not all pure risks are equally insurable. The more closely a risk aligns with the following characteristics, the more insurable it is. An ideally insurable risk must be due to chance. It must be pure risk and not speculative risk. It must be definite, definable as to time, place, and cause. It must also be measurable in financial terms, and the chance of loss must be measurable in frequency and severity. Frequency is the number of losses that can occur in a given time. The loss must be accidental from the insured's viewpoint. The law of large numbers must apply. The loss must create economic hardship for the insured, and the loss must not be catastrophic in nature. It must exclude catastrophic losses, and the losses must be random and independent. Let's now talk about insurable events. An insurable event, as defined by the California Insurance Code, is any contingent or unknown event, whether past or future, that may affect a person having an insurable interest or create a liability against them, may be insured subject to the provisions of the California Insurance Code. A lottery or its outcome shall not be insured against. A policy executed by way of gaming or gambling or wages is void. So this above definition shows up on the test. Basically, the code states that only losses resulting from events that exist but may or may not happen can be insured. The more predictable or likely a loss becomes, the less insurable it is. The more unpredictable or unlikely a loss becomes, the more insurable it is. Let's look at some additional definitions. Insurable interest means the policyholder or policy owner must establish that they actually have a financial interest in the life or property to be insured. Insurable interest requires that the policyholder must face personal risk of loss, have a legitimate financial interest in preserving the life or property being insured, and the insurance applied for does not achieve a potential for gain. Public policy requires that the insured have an insurable interest in any property or life to be covered by the policy. Policies not covering an insurable interest are illegal and void because they are considered wagering contracts, gambling on other persons' lives or property. Such contracts increase the likelihood of intentional harm or destruction. So, for example, I could not buy an insurance policy on you. If you die, I suffer no financial loss. I have no insurable interest in your life. My spouse, however, or my key employee at my business, however, I would suffer financial loss if either of them died, and I could purchase a life insurance policy. In life, health, and disability contracts, insurable interest means that the person acquiring the contract, the applicant, must be subject to a financial loss upon the death, illness, or disability of the person being insured. A policy obtained by a person not having an insurable interest in the insured is not valid and cannot be enforced. Every person possesses an unlimited insurable interest in their own life and may name whoever they wish to be their beneficiary. As a general rule, a person applying for insurance on the life of another must have an insurable interest in the other person's life. Even if the applicant has an insurable interest, the consent of the other person to be insured is required before a policy can be issued. A spouse cannot lawfully purchase a policy on the other spouse's life unless they have that person's permission. There is one exception to this general rule. A parent can, without the child's consent, purchase a relatively small amount of life insurance on the life of a minor child, since the child does not have legal capacity to consent or enter into a contract. In life insurance, insurable interest is based on a relationship where there's a common interest in another person continuing to live, or financial loss that would result at death. In the class of disability or health insurance, if the applicant and the insured are two different people, insurable interest means the applicant must be in a position to suffer a financial loss should the insured incur medical expenses or become disabled. Insurable interest must exist at the time of the application for the class of life, disability, and health insurance, but it does not need to exist at the time of the insured's death or at the time of a health insurance claim. In contrast, for property and casualty insurance, insurable interest must exist at the time of the application and at the time of loss. Let me give you an example. If I buy a life insurance policy on my spouse and we later get divorced and she's no longer married to me, and then she dies, I can still collect the benefit of that life insurance because I had an insurable interest in her at the time we applied for the life insurance. Even though when she dies, she's no longer my spouse and I no longer have insurable interest in her life. In property casualty, however, for example, home insurance, you must have insurable interest when you buy purchase the property casualty insurance through the application, and you must also have insurable interest at the time of the claim. For example, I insure my home, but then I sell the home, I no longer own it, but I forgot to cancel the property policy. And then if the home burns down, I cannot collect on that policy because I no longer own that home. I no longer have insurable interest. Even though the policy is still in force and I'm still paying the premium. Let's now talk about the principle of indemnity. In property and casualty, the principle or concept of indemnity is to restore the insured to the same financial position they occurred prior to the loss. The insured should not be able to gain or be in a better position than before the loss. As one company says in their advertising, we will get you back where you belong. Indemnification can take the form of repair, replacement, or payment of the damaged or destroyed property. In life and health insurance, the concept of indemnity has a slightly different meaning in that the value of a person's life is represented by their present and future earning power. Indemnification can take the form of cash proceeds to replace a wage earner's lost income or pay for medical bills. The purpose of the principle of indemnity is to prevent the insured from profiting from a loss and to reduce moral hazards or dishonest acts. Let's talk about the concept of utmost good faith. A good faith contract is one in which both parties know all the material facts and any relevant information. Neither party may attempt to hide information, which means they must not lie and must also speak up with known information. Failure to do so may entitle the other party to void or rescind the contract. So insurance policies are all contracts of utmost good faith. Let's now talk about underwriting. Though the purpose of underwriting is risk selection, classification, and rating. However, what does underwrite mean? The word underwrite originated in England in the 1600s when the first policies of insurance were drafted and accepted. English merchants were seeking to insure their ships and cargo as they shipped from England to the new colonies, and they would post letters of agreement or proposals stating the amount of cargo value and the amount of insurance they needed with details of the risk. They would place these on a bulletin board. These details would include the ship's condition, the name of the captain, type of cargo, and destination. They'd post these proposals in coffee houses along the waterfront in London. One coffee house owner, Edward Lloyd, began making additional information available concerning weather conditions, ships, tides, the quality of the captain, and routes that he published in the newspaper. Those willing to assume a portion of the risk would write their name under the proposal. Thus the terms underwriter and underwriting began. The people shipping the cargo would put money in a pot for that ship, and the people underwriting it would put a percentage next to their name, for example, 10%. So if the ship made it all the way to Boston and did not sink, the money in that kitty would be divided up amongst the underwriters according to the percentage. So the guy that wrote 10% would get 10% of the little pot of money. However, if the ship sank and lost all the cargo, he would have to pay 10% of the value of that cargo so that the owners of that cargo were reimbursed and did not lose financially. That's how insurance all started at Lloyd's of London's coffee house, which, by the way, that company still exists in business today. The overall objective of underwriters is to accept applicants who together will be a profitable risk for the insurance company and enable the insurer to return a profit to stockholders or policyholders. Underwriters do this by selecting and rating risks offered to the insurer. They determine whether an applicant is an insurable risk, and if so, they set the appropriate rates and coverages. Underwriters thus protect the interests of the policy owners and stockholders and ensure that the company makes a sufficient profit to stay in business. The purpose of underwriting and the principal functions and objectives of the underwriters are: review applications to determine whether or not risks are acceptable, reduce adverse selection by eliminating risks that do not meet the underwriting standards, and classify risks to establish appropriate rates and premiums for the degree of risk and benefits involved. In order to underwrite an application for life, health, or disability insurance under the company's underwriting standards and guidelines, the underwriters typically examine a number of risk factors and use different tools to determine risk acceptability. These include looking at the current health and physical conditions, the personal health history of the applicant, occupations and hobbies. Does he do dangerous things? his personal habits, including tobacco use and a history of alcohol or drug use, age, sex or gender, and other contributing factors such as military status, driving record, and the total amount of insurance purchasing. Some of the things they evaluate are blood and urine and saliva tests, physical or hospital medical records, prescription drug profiles, a telephone interview, financial information, and vocation or occupation or hobbies. Let's talk about adverse selection. Adverse selection is the process by which consumers with the greatest probability or chance of loss are the most likely to purchase and maintain insurance in force. Adverse selection appears whenever an individual has the freedom to buy or not to buy, to choose the amount or plan of insurance, and to continue or discontinue being insured. Underwriters protect the insurance company from adverse selection by selections of risks, classification, and pricing. One example of adverse selection is in these tragic wildfires in California. If someone doesn't have insurance on their home and the fire is approaching their neighborhood and they can see the flames over the hill, then they pick up the phone to call an insurance company to buy insurance. That's adverse selection, only buying insurance when you absolutely know there's going to be a loss occur. Underwriters prevent that from happening. Underwriters protect the insurance company against adverse selection by attempting to take a higher than average risk and making it fall within the normal range through increasing the price or putting limitations on the coverage. The methods available to the underwriter to do this are charging a higher rate, placing restrictions or exclusions on the policy, or limiting when the policy will perform. And then the last concept is profitable distribution of risks. When the company works to pay claims and other expenses and still make a profit, the degree or range of risk is known as spread of risk. Underwriters must be careful not to accept too many higher than average risks in order to make sure that the entire book of business maintains a spread of risk. The underwriter's goal is to achieve profitable distribution of exposures, which means they must select a broad base of risk where the average loss or claim falls within normal ranges. This is accomplished by balancing higher risks with a number of lower risks so that the losses average out into the normal range. Let's continue with our general insurance discussion with the next section, contract law. Though insurance policies are governed by the general principles of contract law, the formation of these contracts are different depending on the type of insurance. For example, an agent can issue a binder, which is temporary insurance contract for your automobile. This binder temporarily obligates the insurer to provide the coverage pending the issuance of the policy. The reasons agents have the authority to issue binders in property casualty insurance is that these types of contracts are short-term and the insurance company reserves the right to cancel the policy if the risk appears too unfavorable. The company has 60 days to investigate the application and make a decision whether to accept or decline the risk. A life or accident and health agent has no authority to bind coverage. The only authority they have is to solicit applications or offers from prospective insureds and submit them, along with the initial premium, to the insurance company's underwriting department. Their authority is restricted because contracts such as life insurance are not cancelable once issued, and they're long-term contracts. Whether it's life, health, or disability, the acceptance of the risk is based largely on medical information which a producer is not qualified or in a position to evaluate. The underwriting department has the medical expertise as well as other investigative sources to determine the desirability and insurability of the risk in life insurance. Let's now talk about contract law and tort law. Before addressing life, annuity, health, and disability contracts, it's important for you to have a basic understanding of contract law. Insurance policies are legal contracts, personal contracts between the policy owner and the insurance company. This means they're governed by the same legal principles that are applicable to the formation of any contract, plus the specific principles and features that pertain only to insurance contracts. Contract law is different from tort law. Tort law concerns itself with private civil wrongs that are independent of contract law and are committed against individuals. Tort law protects against the wrongful invasion of another person's rights given rise to legal liabilities or lawsuits that are settled in civil court. Most torts are covered by liability insurance. In this section, we're going to review the principles of contract law as well as the unique features that pertain to insurance contracts. Here's an overview. There's an overview chart in your text, and it shows that there are certain elements that apply to all contracts, and they are agreement, which is offer and acceptance, competent parties, legal purpose, and consideration. Plus, there's unique features that apply only to insurance contracts, and these are contracts of adhesion, conditional contracts, alliatory contracts, unilateral contracts, personal contracts, contracts of utmost good faith, contracts of indemnity or valued contracts, and insurable interest. Let's review each of these different unique features. For a contract to be enforced by law, it must contain 4 elements: agreement, which is the offer and acceptance, consideration, competent parties, and legal purpose. Let's discuss each of these. To be legally enforceable, a contract must be made with a definite, unqualified offer by one party and the acceptance of its exact terms by the other party. An agreement is formed when one party makes an offer and the other party accepts. In insurance, the applicant makes an offer by completing an application and submitting it along with the premiums to the insurance company. Should the applicant not include the premiums, this would be considered an invitation to an offer. The insurance company then shows acceptance by issuing a binder or a policy as applied for. If the insurer or the insurance company issues the contract as applied for, if it cannot issue the contract as applied for due to a rating or imposed limitation, they would make a counteroffer to the applicant concerning the new terms. Let's now talk about competent parties, legal capacity. Both parties must be capable and willing to enter the contract for it to be legally binding. Generally, this requires that both parties be of legal age, mentally competent to understand the contract, and not under the influence of drugs or alcohol. Applications of minors must usually be signed by an adult parent or guardian to comply with the legal age requirements for making contracts. An insurance company is considered competent if it has been licensed or authorized by the state or states in which it conducts business. Now let's talk about legal purpose. The purpose of the contract must be legal and not against public policy. This means the person's activities or the purpose of the contract cannot be illegal. This usually applies if an action is considered a felony. For example, a policy with accidental death benefit would not pay if the insured was killed in an explosion while cooking meth in his apartment. His illegal activity, killing him, would void the contract. In most states, a beneficiary who's accidentally caused an insured's death does not forfeit the life insurance proceeds. If the beneficiary, however, killed the insured in an act of self-defense or while insane, they would still be entitled to collect the insurance proceeds. However, if the beneficiary obtained a life insurance policy intending to kill the insured for the proceeds and does in fact kill the insurance company can void the policy. Let's talk about now consideration. For a contract to be enforceable, The promise or promises it contains must be supported by consideration. Consideration, the binding force of a contract, refers to what each party considers valuable. Consideration on the part of the applicant means paying the initial premium and the representations made in the application. Consideration on the part of the insurance company is the promise to pay in the event of a loss. There are now special characteristics of an insurance contract, and let's look at those. The elements we just discussed must be contained in every contract in order to be enforceable by law. The following are unique features or characteristics that pertain to insurance contracts and set them apart from other legally binding contracts. First is a contract of adhesion. A contract of adhesion is prepared by the insurance company and accepted or rejected by the insured. Insurance policies are not drawn up through negotiations, and the insured has little or no say about the policy's provisions. In effect, the applicant adheres to the terms of the contract when he or she accepts it. If a contract is confusing or ambiguous, then the courts will normally interpret the contract against the party who drew it up, meaning against the insurance company and in favor of the insured. It's also considered an alliatory contract. An alliatory contract is dependent upon the occurrence or happening of an uncertain event. This means there's an element of chance for both the insured and the insurance company, and the dollar values exchanged may not be equal. For example, an individual has a 10-year life insurance policy. The beneficiary will receive the death benefit if the insured dies during the 10 years. If the insured does not die, then no benefits are payable. It's also considered a unilateral contract. Insurance contracts are unilateral in that only one party, the insurance company, makes any kind of enforceable promise. The insurer is bound to its contractual obligations under the terms of the contract once the premium is paid. Should the insured die or become disabled, the insurer or insurance company is contractually bound to fulfill its promise to pay. However, the insured makes no promises, not even a promise to pay the premium. The insurance company cannot require that premiums be paid. They can only cancel the contract if premiums are not paid. It's also considered a personal contract. With the exception of life insurance and some cargo insurance, insurance contracts are personal. A personal contract is a personal agreement between the insurance company and the insured. This means that the contract follows the person, not the property insured. A homeowner cannot transfer or assign their existing homeowner's policy to the person who just purchased their home without obtaining the insurance company's consent or agreement. When the insurer underwrote the person or underwrote the homeowner's policy, they considered the moral and morale character of the owner of the home as part of their decision to accept the risk. They know nothing about the character of the new owner, so therefore it normally requires a new policy be written in the name of the new owner. In life insurance, the policy owner and the insured may not be the same person. For example, parents can own a policy on the life of their children, or a husband can own a policy on the life of his spouse. The underwriting was completed on the insured. When transferring ownership of a life policy, the insured remains the same. Only the policy owner is changed. This is why life insurance uses the term policy owner instead of policy holder. Life insurance policies, or all insurance policies, are considered valued policy. A valued insurance contract pays a stated sum, regardless of the actual loss incurred when a covered loss happens. Life, accidental death, and disability insurance are valued contracts. If the insured purchases a $100,000 life insurance policy and dies during the policy period, the beneficiary will be paid $100,000 per the value stated in the policy. Let's now talk about some insurance policy definitions. The policy is the written instrument in which a contract of insurance is set forth, outlining the obligations and responsibilities of the insured and of the insurance company. Why is it necessary that an insurance contract take the form of a written instrument known as a policy? Consider the enormous amounts of money involved, as well as the duration of some of these contracts. Life insurance can provide protection to the insured's age 100, and some of the newer policies are offering protections even longer. Every effort must be made to avoid confusion and misunderstanding on what the policy owner is being promised or not promised in the form of benefits. It was decided early on that the best way to clarify the agreement was to put it in writing in the form of a written contract called an insurance policy. Here are some other terms that you need to know. Fraud is an intentional act to deceive for unlawful gain. Concealment is defined in the California Insurance Code as neglecting to communicate that which a party knows or ought to communicate. Concealment, whether intentional or unintentional, entitles the injured party or insurance company to rescind or void the contract. Concealment simply means the failure to fully disclose all pertinent, relevant information. For example, if the applicant is asked, "Have you seen a doctor in the last 5 years?" and the applicant answers, "Yes, I went last year to urgent care for a sinus infection and chest cold," but intentionally fails to state that he or she also saw a specialist to consult about headaches and dizziness, the applicant is guilty of concealing or hiding the truth. He concealed or hid the truth about his or her health. Concealment includes partial truth because it is still leaving out information that the other party is entitled to. In order for concealment to void a contract, the lack of information must be material, and not knowing it place the other party at a disadvantage. Remember, it does not matter if it was done on purpose, intentionally, or not on purpose, unintentionally, it still voids the contract. The right to information of material facts may be waived either by the terms of the insurance or by a person's neglect to inquire about such facts when such facts are distinctly implied in other facts that are communicated. This is what this means on the test. There's no concealment if there was no inquiry. Let's now talk about warranty. We have previously established that statements on the application must be true, and that truth is defined as either a warranty or a representation. A warranty is a very strict definition of the truth because it's a statement made by the applicant that is guaranteed to be true in all respects. It becomes part of the contract, and if found to be untrue, can be grounds for revoking or rescinding the contract. Warranties are statements guaranteed to be absolutely true. Contract law presumes warranties to be material, and their breach or violation by either party, insured or insurance company, entitles the other party to rescind or void the contract. Warranties are either expressed, written, or implied, not in writing, which means they are incorporated by reference. Warranties can relate to past, present, future, or any and all of these. Warranties require strict compliance. Warranties are found in property casualty insurance, but not in life, health, or disability income policies. A representation may qualify as an implied warranty. The violation of a material warranty or other provisions of a policy on the part of either party entitles the other to rescind the contract. Let's now talk about materiality. A material fact is a statement made that is important to the contract and that could change the decision to provide either insurance or the premium. Concealment or false statements, misrepresentations about material facts may allow the injured party to rescind or void the contract even at a later date. Material always refers to the importance of information to the insurance contract. For example, the information that a prospective insured is a male, 5 feet 7 inches tall, and weighs 160 pounds, when in fact the prospective insured is 5 feet 7 inches tall and weighs 106 pounds, would be material or important, since the proposed insured's weight is below the required weight on the weight table for even a small-framed male individual. Now, if the application stated the insured's birth date as 8/7/75, when in fact it was 8/27/75, this would prove to be immaterial, not important. Let's now talk about representations. Representations are oral or written in writing statements to the insured's best belief and knowledge. For example, the insured's application would ask if the applicant had any disease or disorder of the circulatory system. If the applicant said no, but actually did have hardening of the arteries but did not know it, this statement would hold up as a representation because it's based on what the applicant believes to be true. Representations are oral or written statements made to the best of one's belief or knowledge. Representations are made at the time of the application or before issuance of the policy. Representations can qualify as implied warranties, but not as expressed provisions in the contract. A representation to the future could be considered a promise. Materiality of a representation is judged the same as materiality of concealment. A representation is false when it fails to correspond with assertions or stipulations. If it is false in material point, the injured party may rescind the contract. A representation may be altered or withdrawn before the insurance is issued, but not afterwards. A misrepresentation occurs when the information is false. Warranties and representations are used to define the truth. Concealment and misrepresentations are used to define what is not true. A misrepresentation is written or oral representation that is false, and if material, makes the contract voidable. Misrepresentations are misstatements of past or present facts. However, for the misrepresentation to have any effect on the application or policy issued, it must be a statement that is false or misleading, relates to a material or important fact, and relied upon by the insurance company in issuing the policy. Those transacting insurance business are expected to represent honestly their policies and the policies against which they compete. Misrepresenting or false advertising of a policy or a company is illegal. Let's now talk about twisting. Twisting is the unlawful act of misrepresentation to convince someone to materially change a policy or drop one policy in order to purchase another policy from a different insurance company. This is prohibited. California law specifically states that a person may not make any misrepresentations, misleading representations, or comparisons to induce someone to purchase an insurance policy or to refuse to accept an issued policy in order to take out a policy with another insurance company, or to induce a policyholder to lapse, forfeit, or surrender their existing insurance policy. Twisting is considered misrepresentation when an insurer or agent leads a person to believe that dividends are guaranteed or can be expected. It's twisting to make a misleading comparison, whether misrepresentation or concealment, that induces the person to take out a policy, refuse to accept a policy, or lapse, forfeit, or surrender a policy that it currently has. This is considered twisting. An agent who knowingly misrepresents or commits the act of twisting can have their license suspended for up to 3 years, and an insurer or insurance company who knowingly allows misrepresentation or twisting may have their certificate of authority suspended in that class or line of insurance. Let's now talk about rebating. Rebating occurs when a producer or agent returns a financial benefit to an applicant as an inducement to purchase insurance. Rebates may include cash, items of value, or even personal services. California currently does not have a rebate law for the insurance industry, so technically rebating is legal in California. Let's talk about waiver and estoppel. Waiver is the intentional and voluntary surrender of a known right, an act which the insurer may or may not have committed in many situations. A waiver occurs if the insurer knew it had the right to do or demand some action, but acted with the deliberate intention of giving up that right. For example, an insurer who gives a policyholder extra time after the grace period has expired to pay premiums and agrees to keep the policy in force during that time may have waived its right to deny a claim during that time period for non-payment of premiums. This means if the insured dies during the extra time extended period, the insurer may still have to pay the death benefit to the beneficiary. Estoppel prevents an insurance company from reasserting a right that it previously waived, or changing conduct the insured has begun to rely on and act upon, if doing so would be harmful to the insured. Example, if the insurance company issued a policy with a question unanswered, they waive the right to that information. Estoppel would prevent them from canceling or denying a claim based on the information that the unanswered question would provide. Let's talk about the Peril evidence rule. This is oral evidence or evidence given verbally in a court of law. The Peril evidence rule states that when parties put the agreement in writing, all previous verbal statements come together in that writing, and a written contract cannot be changed or modified by the Peril evidence rule. In other words, you can't change the contract verbally, it has to be done so in writing. How about void versus avoidable contracts? These two terms are often incorrectly used interchangeably. A void contract is simply an agreement without legal effect. In essence, it's not a contract at all, for it lacks one of the elements specified by law for a valid contract. A void contract cannot be enforced by either party. For example, a contract having an illegal purpose is void. Avoidable contract, on the other hand, is a contract which, for some reason satisfactory to the court, may be set aside by one of the parties to the contract. It is binding unless the party with the right to reject it wishes to do so. An example of this would be entering into contract with a minor. The minor could void the contract if they chose, but the insurance company cannot. So avoidable contract is the one that can be avoided by either party. About the meaning of rescission. Rescission is the revocation of a contract. It means the contract is terminated or voided from the beginning and treated as if it never existed. Both parties have a certain amount of time during which they can rescind a contract. Rescission is similar to the annulment of a marriage. Rescission means to reject a contract for cause. The rescission of an insurance policy refers to its recall and voiding. An insurance policy can be rescinded for material concealment, for material false misrepresentation, and for violation of a material warranty or other material provision of a policy on the part of either the insured or the insurance company. There are 6 requirements that all insurance policies must contain. According to the insurance code, insurance contracts are required to contain these 6 specifications. Number 1, the parties between whom the contract is made, the insurance company and the insured's name, the property or the life to be insured, the interest of the insured in the property, or if he or she is not the absolute owner, their share of the interest. The risks insured against, these are the perils, the period during which the insurance is continued, and either a statement of the premium or If the insurance is the type where the exact premium can only be determined upon termination of the contract, then a statement on the basis and rates upon which the final premium is to be determined and paid. This is like workers' compensation. They estimate the premium at the beginning, and you can't tell the true premium until the end of the contract when an audit is completed. Let's now identify some terms used in the insurance industry. The following terms apply to life, health, and disability income policies. You must be able to identify these following terms correctly as they relate to contract law. Application. The application is a formal written request, sometimes referred to as an offer, by the applicant to the insurance company requesting a policy to be issued based on the information contained in the application. It is the agent's primary underwriting role to make sure the application is complete and contains the proper information and signatures required by the insurance company. Policy is the written instrument known as the insurance contract or agreement between the insurance company and the policy owner. The policy, including all riders, amendments, or modifications, constitutes the entire contract of insurance. A rider, generally, the term refers to a supplemental agreement attached to and made part of the policy. Riders are added to the policy in order to add, modify, or delete policy provisions or coverages. Cancellation, lapse, grace period, renewal, and non-renewal. The act of terminating an insurance policy before the end of the policy period. This is sometimes referred to as midterm termination. In life and non-cancelable health and disability income policies, the insurer generally may not cancel a policy except for non-payment of premium. Lapse is termination of a policy because of failure to pay a premium within the grace period. If the variable and universal life policies, it's the depletion of cash value below the amount needed to keep the policy in force, and this is considered a lapse. The grace period is the time period after the policy's due date in which a late payment may be made without penalty. In life insurance, it's normally 30 or 31 days after the due date. In health and disability insurance, it may be 7 days for a weekly policy and 10 days for a monthly policy and 31 days for all other modes of payment. Renewal means continuance of an insurance policy beyond its original term. Also, the payment of premiums after the first year of the policy effective date, or the agent's commissions on such second and subsequent years premiums are considered to be renewed or renewals. So agents refer to a renewal as that time when a policy has expired and it's time to pay the next year's premium. Non-renewal, a policy written for a specific period, discontinuance by an insurance policy beyond its original term. So a non-renewal notice is sent by the insurance company 60 days before renewal telling the customer, we're not going to renew this policy. Rate, premium earned, and unearned premium. The rate is the cost of a given unit of insurance. In life insurance, it is generally the price per $1,000 of coverage. In disability income insurance, it's usually the price of $100 per monthly benefit. Premium is the periodic payment required by the insured to receive policy benefits and keep the policy in force. The premium is paid by the policy owner to the insurance company. Earned premium, the portion of the premium that has been used to pay for the protection or coverage provided by the insurance company. Depending on the type of cancellation, the insurance company keeps the earned premium and returns the unearned premium to the policy owner. Premiums are earned in property casualty by the day. Premiums are paid in advance, usually 6 months on an auto policy, 1 year on all other policies. So in the example of an auto policy, let's say the customer paid $600 for 6 months of coverage. That's $100 per month. They decide to cancel the policy after 3 months. The insurance company earned the premium for the first 3 months, and they get to keep that. The second 3 months is unearned. and the insurance company can refund that unearned because there was no coverage given. Unearned premium is defined as the portion of the premium the insurer has collected but not yet earned because coverage has yet to be provided for those dates. The two terms are important in cancellation. Insurance premiums are paid in advance, and insurance companies calculate daily the earned and unearned premium. Whether a policyholder is entitled to a refund of the full unearned premium upon cancellation depends on the nature of the cancellation, the type of cancellation. There are generally three methods of returning unearned premium when a policy is canceled. A pro rata cancellation means that the premium is adjusted proportionately based on the exact amount of time that the policy has been in force. This method is usually used when the insurance company cancels a policy. So if the company cancels a policy and there's unearned premium due, they pay all of the unearned premium to the customer. However, a short rate cancellation means that the premium returned to the insurance customer is not in exact proportion to the number of days remaining in the policy period. In effect, the insurance company charges a penalty and the insured doesn't get all of their money back. For example, in my example of $600 premium for an auto policy that was used for 3 months, that's 50% used, so the company keeps 3 months of earned premium and owes back $300. Well, on a short rate cancellation, they're going to keep 10% of the refund, or $30, and send the customer a refund check for $270. And a flat rate cancellation means a policy is canceled as of its effective date. Usually this means that no premium is charged, no coverage was given, and the policy has not been in effect at all. A free look is an example of a flat cancellation. Let's move on and discuss marketing distribution systems. A life, health, or disability insurance company must have a continuing incoming flow of new profitable revenue, and this is accomplished through the distribution of its products, which simply means creating and keeping clients. There are many ways of doing this, since an insurance products can be, and in fact are, sold like any other product, from vending machines in airports to direct solicitations in the mail to offers on the internet. The insurance industry uses a variety of distribution systems to provide insurance to the public. Distribution, also known as marketing systems, common in California, include three major categories: the agency system, the direct response system, and home service system. The agency system, in reality, the overwhelmingly dominant distribution method, is the individual producer or agent who makes face-to-face sales calls with customers. Since these producers operate in field offices, typically called agencies, in locales wherever a market for life, health, or disability income products exists, this method of distribution is called the agency system. The agency system has two main branches. In the first, a company builds its own agency distribution system by recruiting, financing, training, motivating, housing, and supervising new agents to represent it exclusively. This branch of the agency system is identified with the descriptive adjective agency building or career agency. In the second, a company taps into the existing pool of agents created by the building branch referred to above to create an instant sales force. This branch is referred to as being the independent agency system. An independent agent represents more than one insurance company simultaneously. Career agencies are a branch of major stock and mutual insurance companies that are contracted to represent the particular insurer in a specific area. In career agencies, agencies are recruited, trained, and supervised by either a manager employee of the company or a general agent, GA, who has a vested right in any business written by his or her agents. The focus in the career agency system is on building the sales staff. The next system is the direct response system. Direct response is also known as direct mail. This system usually does not use a producer. It is a form of mass marketing. Direct response marketing consists of making sales to consumers through the mail, media advertising, telemarketing, or the internet. The process typically includes standardized sales messages made to consumers, orders taken, products delivered, and payments remitted without a face-to-face meeting between the applicant or a producer agent. Some insurance companies rely completely on direct response systems to distribute their products, while other insurance companies use direct response as just one of several distribution methods. Internet selling is the latest channel to be added to this type of distribution mix. Just about all insurance companies have an internet presence, and a significant proportion of them make it possible to buy over the internet. However, the main use of insurance company internet sites is for education, service, and information, and not for sales. Let's talk about home service. Home service agents are producers who spend at least 75% of their time selling ordinary or small individual life and disability products for one insurance company that provides financing, training, supervision, sales support, and other facilities. Unlike other agents, a home service agent sells in an assigned territory called a debit or a debit route, and sometimes collects the premium at the insured's house or office. An agent working a debit route will call on the same customers every week on the same day to collect that week's premium. Other distribution methods. Stockbrokers should be included among producers because an increasing number of them sell annuities, single premium life, and variable products. Financial planners are producers who usually work on a fee-only basis, sometimes fulfilling the insurance portion of the plan with a commission-free or no-load product. Although there is no agreed-upon definition of financial planners, it's usually understood that they provide clients with a total financial plan that includes everything from investments to insurance, and they usually have a planning-oriented designation like CHFC or CFP, CHFC Chartered Financial Counselor, or CFP Certified Financial Planner. Banks and companies that issue credit cards, non-insurance sponsors, are also offering insurance products. This marketing system reaches a select group of individuals who have a history of making periodic payments. Vending machines located in airports that provide travel and accident policies offer a large amount of coverage for a low premium. However, this coverage only applies for the duration of a single trip. Worksite marketing is another growing distribution channel. It consists of individuals who go to a workplace and, with approval of management, conduct sales interviews with employees on site. Premiums paid for the products sold are often being payroll deducted through the employer's payroll system and then paid to the insurance company. That concludes this section. Now on to the test tips.